I've really been 100% focused on the long game. So really thinking about what am I doing today and how can I have the greatest impact over a 10, 20 or 30-year time period. And I've been doing that substantially in my business and the type of clients I'm working with, the advice that I'm providing and the books that I write and those sorts of things, but also in my personal life and investment life. And I've got a very clear vision of what I want out of life and where I want to spend my time and what I want to do with life.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You'll hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi, freedom fighters. What's your focus? On the short term or the long term? On the immediate or the infinite? What's your vision of what you want out of life? Of where you're going to spend your time? And what you want to do with your life? And what proven rules are you consistently applying to help you get there? My guess is that you've been too busy to really consider these questions. That the busyness of life just keeps getting in the way, and even if you could squeeze in a few minutes to think about them, you'd be so tired that it's easier to flick on Netflix or scroll through Facebook. But at some stage, you're going to need to make the time and take the time to start investing in yourself. In my conversation with today's guest, Stuart Weymss, spread across this and the next episode, will give you both the inspiration and the information to start making it happen. Because, as Stuart has made famous, it's the start that stops most people. Now, one of the great privileges of hosting this podcast is that I get to connect with all of the people I've respected and admired over the years. In this regard, today's guest, Stuart Weymss, is another of my virtual mentors. In many ways, Stuart is another one of my, what I call Siamese twins from another mother, because we both think and act the same in relation to investing in yourself and living by design. Along with adopting a holistic integrated approach where investing is an elite team sport and a game of finance. In his words, he also eats his own cooking, or he walks his own talk, as I'd say, in terms of personally investing in the same way that he advises his clients to do. Now, Stuart's a qualified chartered accountant, an independent financial advisor, and a mortgage broker. And this is a rare combination that enables him to deliver truly holistic advice that considers all aspects and impacts of investment options. Now, like myself, Stuart has always passionately believed in the need for people to be able to access a trustworthy source of independent financial advice. Nothing upsets us more than to hear about selfish advisors ripping off their unsuspecting clients. And like me, this passion is what drives him to write books and blogs, publish podcasts, appear in the media, advise his clients, mentor his staff, and give presentations. Whatever it takes to help more people access a source of unbiased information and advice. Now, if you'd like to hear more about Stuart after enjoying this and next week's episode, you can subscribe to his blog and his podcast at www.investopoly.com.au. That's INVESTOPOLY, Investopoly. Now, as an aside, Stuart is also a big Geelong Cats fan in the Australian Football League, so he's still licking his wounds after my mighty Richmond Tigers beat them recently in the grand final to successfully secure our third premiership in 4 years. Go you Tigers! But I'm getting a little bit off track now. Now, returning to our opening questions, to achieve and fund your preferred lifestyle, you're going to need to do two very key things. Firstly, understand and apply the time-tested rules for mastering wealth, which we'll discuss today from Stuart's book, Investopoly. And secondly, appreciate that investing is a game of finance and an elite team sport. Now, we'll delve into this more in the next episode, where we dive into Stuart's most recent book, The Rules of the Lending Game. So let's start by getting into the time-tested rules for mastering wealth that you'll need to appreciate and apply. And I'm going to do this by reading and paraphrasing directly from Stuart's book, Investopoly, The 8 Golden Rules for Mastering the Game of Building Wealth. And what's comforting about Stuart's 8 Golden Rules is that they actually line up with the 8 preventative wealth vitamins or principles that I reveal in my own book, The Freedom Formula. So I guess it's a case of great minds think alike, or perhaps I'm kidding myself and it's fools never differ. I'll let you decide. The good news for you is that they are both proven and time-proven evidence-based rules and timeless frameworks. We haven't invented them. We're just collating them in one place in a way that's easy for you to understand and implement. When Stuart and I meet potential investors for the first time, they tend to ask us questions like, I know I need to do something, but where do I start? Should I focus on repaying my home loan, or should I be investing, or both? Do I need to invest in property as well as shares? Or do I need to contribute more into super, or look at different options? No doubt you have similar questions. And helping you answer questions like these is exactly why Stuart wrote Investopoly. In it, he outlines how you can plan your financial journey using a robust and proven investment framework, Stuart's 8 golden rules to winning the game of building personal wealth. What financial steps you need to take next will only become clear once you understand how this game and its rules work. Now, we all know that games are won by applying proven rules and strategies. And I'm sure you've noticed that the title of Stuart's book, Investopoly, is a play on the board game Monopoly, the ultimate trading game. And let's be honest, winning Monopoly requires a little bit of luck, for example, landing on unowned property, and avoiding properties already owned by your opponent. But in truth, the key to winning this game is making the most of your luck, but more importantly, applying certain rules, such as buying as much property as possible, not spending all your cash so that you've got some savings, and negotiating to get a full set of properties as soon as you can. Following these rules will see you winning more games of Monopoly than you lose. And building wealth is no different. You can win at the game of building personal wealth by applying a set of proven rules. These golden rules are all proven, in other words, they work, and they're rooted in logic and simple maths. They're not mine, they're not Stuart's or anyone else's opinion, and they can be verified with historical evidence. These rules include the obvious things like having a plan, spending less than you earn, forgetting about the short term, and always making decisions that maximise your long-term wealth, and, if you're going to invest in property, make sure it's investment grade. So all you need to do is follow these 8 fundamentally sound, easy to understand golden rules. It's that simple. But simple doesn't mean it's necessarily easy to implement. And here's the good news. We believe that mapping out a financial plan to secure your family's future is actually a lot easier than you think. Understanding and consistently applying the golden rules will help you to work out what you should do next, investment-wise, with virtually no chance of making a mistake, even if you don't have a financial brain and all this money stuff is just not your thing. Put simply, these rules put you in control of your financial destiny. Now, it may surprise you to know that virtually all mistakes are predictable, and applying the golden rules will filter out mistakes before they even occur. To reinforce this, very few investment mistakes occur because of random bad luck, and virtually all investment mistakes are predictable. In other words, mistakes are caused by doing something fundamentally wrong. So, if you test all your past and current investment decisions against the 8 golden rules, you'll be able to highlight where you went right and where you went wrong. More importantly, if you filter all your future investment decisions through these 8 golden rules, you'll be able to prevent all predictable mistakes. Applied consistently, these golden rules guarantee success, putting aside, of course, some random bad luck, which very rarely occurs. Now, to put the rules in context, you can build personal wealth in 3 ways: by investing, by speculating, and through business ownership. When trying to build wealth, you need to understand which of these strategies you're adopting because they each have very different risks and wildly different success rates. Many people fool themselves in believing they're investing, but they're actually not. To build wealth safely and successfully, you need to employ an easily repeatable strategy. Good investment strategies and methodologies generate ongoing investment returns year on year with virtually no input from you. However, by contrast, success in speculation in business is rarely repeatable without a lot of intellectual input from yourself. That is, you must keep discovering new ideas, for example, picking a new stock or a new asset such as Bitcoin, or predicting the next growth suburb or development site each year to make money, which is very difficult to do consistently. What we're focusing on here is about pure investment. Pure investing is all about generating the highest return for the absolute lowest risk using proven, repeatable strategies and rules. So here's the 8 golden rules. Golden rule number 1, play the long game. The minimum 10 but preferably 15 year plus investment timeline horizon that I outline in the Freedom Formula. Golden rule number 2, know how much income you need and by when. What I normally refer to as your freedom numbers. Golden rule number 3, spend less than you earn and invest the difference regularly. Now, this sounds obvious, but you'd be surprised at just how many hard-working Aussies just don't get around to this. Golden rule number 4, grow your asset base and then tilt towards income. This is what I refer to as the wealth by stealth capital growth to cash flow curve that I detail in the Freedom Formula. Golden rule number 5, set your asset allocation, or what you invest in, to reduce risk and maximise returns. Golden rule number 6, invest in the share market using low-cost passive investments. Golden rule number 7, only invest in investment-grade property. And finally, golden rule number 8, protect your investments from expected and unexpected risks. Now, all of these are pretty self-explanatory, and unsurprisingly, none of these are earth-shatteringly new. But this is exactly the point. We just need to apply and keep applying all of this proven ancient wisdom. It's not exciting, it's not sexy, but time and time again it works. Ignore them or only part employ them at your peril. The devil here is in the detail. Now, as Paul Samuelson once famously said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take your money and go to the casino. We're talking here about a safe and sure wealth by stealth approach where you accumulate your nest egg by focusing on growth, then liberating it and converting it to cash flow. So to whet your appetite further, let's expand on 3 of these golden rules. 1, playing the long game. 2, setting your asset allocation or what you invest in to reduce risk and maximise returns. And 3, only investing in investment-grade property. Starting with golden rule number 1, playing the long game, Stuart shows that taking a long-term approach with almost all financial decisions is absolutely critical. The best quality financial decisions are always long-term ones, and short-term profit doesn't create long-term value for anyone. He demonstrates why you will ultimately become an unsuccessful investor by thinking short-term and being impatient and greedy. Like me, he knows that delayed gratification is your best friend and an indicator of success. Delayed gratification is the conscious decision to money in a manner that may not enhance your lifestyle in the short term. In fact, it may even have a negative impact on your lifestyle right now, but will substantially improve your financial position and your lifestyle in the long run. And delayed gratification has been proven to provide improvements in many parts of life, including finances. Now, a famous longitudinal study on the impact of delayed gratification, called the marshmallow test, was conducted by Professor Walter Mischel at Stanford University back in the 1960s. The test involved offering preschoolers the option of 1 marshmallow now, or, if they waited approximately 15 minutes, 2 marshmallows, during which time the tester just left the room. Now, several follow-up studies were completed years later in the 1980s and 1990s, and these found that the children who exhibited a capacity for delayed gratification, who waited for the 2 marshmallows, went on to have higher educational achievement, a higher sense of self-worth, and an ability to cope with stress. Understanding that a significant long-term reward comes from making long-dated financial decisions is very important. Most people don't appreciate how significant the differences are in financial terms. Think back over your life. Did you make any decisions 5, 10 or 20 years ago that continue to affect your finances now? They can be good or bad. Would taking a different path have resulted in a significantly improved financial position? Of course, I'm not suggesting that every decision we make should only consider the financial implications. Lifestyle considerations are important, and it's imperative to enjoy the journey rather than sacrificing everything until you reach your destination. Short-term thinking isn't just dangerous when we're thinking about your lifestyle versus investment choices, though. When you've decided to invest, a short-term outlook often creates a lot of anxiety and stress about possible changes in the market. What if the market drops 5% next week? What if the property market bubble bursts? Fear causes people to worry about investing in an asset one day, only for its price to plummet the following day, week or month. This fear often results in paralysis. That is, when faced with a risky decision, it's far easier for humans to do nothing at all. Conversely, if we take a long-term approach, for example, you ask yourself which stock or property you can invest in today that'll be worth 4 times its current value in 20 years' time, then any short-term market price volatility is put into perspective and becomes largely inconsequential. This is the best way to quell any anxiety that you might have about making investment decisions. Now, Howard Schultz, the man who built the 100 billion Starbucks behemoth, once said in an interview with Oprah that short-term profit does not create long-term value for anyone. This is a very profound and important point when it comes to investing. We can all choose from many investment strategies. My proposition is that you should select the ones that are focused on generating long-term value because they have a significantly higher probability of working. We can all choose from many investment strategies. Now, I prefer to assess market returns over the long term, that is, over 20 to 30 years. Doing so means the assessment period includes various political environments, different economic growth periods, numerous interest rate cycles, and changes in law and taxation. The returns from the major growth asset classes of property and Australian and international shares don't vary much over these longer terms. Over the last 25 to 30 years, for example, total returns for these main investment asset classes range from 9.3% through to about 12% a year. This highlights that you can build wealth using any or all of these investment asset classes, so as long as you use the correct methodologies. Which asset class you select depends on your situation and your goals. Now, based on these market returns, taking a long-term approach means that you can expect an investment return of approximately 10% per annum if you invest in any of these asset classes. With the correct investment strategy, these returns will be sufficient for most investors to achieve your long-term lifestyle goals. This highlights the big difference that exists between speculation and investing. If you can obtain a long-term return of 10% per year, Why would you even need to speculate? The only answers I can think of that you might be impatient or greedy or both. Or you might feel it's more exciting, and if it works, it'll make you feel smarter than the average investor. All of these reasons are flawed in my opinion, and you're better off sticking to what works. As world-renowned author Jim Collins says, great questions are better than great answers. I believe the single best question that you can ask yourself is, what investment decision can I make today that will dramatically strengthen my financial position in 10 to 20 years? To answer this question often yields the highest quality answer from an investment perspective. Let's now return to golden rule number 5, setting your asset allocation to reduce risk and maximise your returns. Now, American investor, economist and professor Benjamin Graham taught Warren Buffett that investing has only two rules. Rule 1, never lose money. Rule 2, refer to rule number 1. But how does this help you and what you should invest in? Should you focus on property, shares, bonds, commercial property, cash, or something completely different? This question is called asset allocation. That is, how you allocate your investment dollars towards different investment asset classes. Before you get stuck into your investment strategy, you need to understand a few fundamental observations about asset allocation though. Historical data on returns and volatilities helps to demonstrate why this is so important. In the absence of such an understanding, you're highly likely to make costly mistakes in relation to where your investment dollars are directed to various investment asset classes, such as shares, property, cash or bonds. Do you put all of your money into direct residential property or everything into the share market? Or do you spread it across all the major asset classes, and if so, in what proportions? What's the right asset allocation? Well, before we have a look at this, why is asset allocation an investor's most important decision? Because many academics and professionals regard asset allocation as an investor's most important decision. Because your asset allocation determines your portfolio's performance, your risk, and your volatility. By investing in different asset classes in different proportions, you should be able to minimise your probability of making a loss in any one year and ultimately maximise your long-term returns. To understand why asset allocation is so important, we have to make friends with one very important fact. That is, that no one knows which asset class will perform the best in the short term, say over the next 1 to 5 years. No one in the world has developed a reliable way of consistently predicting short-term asset class returns. If someone tells you that they know which direction an asset class like shares or property will move in the very short term, run in the opposite direction. No one has a crystal ball. We can't control markets and therefore we can't control returns. No one can. Returns are random and are influenced by dynamics outside of our control. Therefore, knowing this, we must invest in a way that, regardless of what happens, for example, shares are up while property's down or bonds are up while shares are down, we have the best possible chance of generating a positive overall return. That is, not lose money. Put simply, you really need a finger in every pie. So let's now turn to the types of asset allocation methodologies. The two dominant types of asset allocation methodologies are strategic and tactical. A strategic asset allocation is set based on an investor's risk profile and investment time horizon, or how long until you stop work, while also having consideration of long-term historical investment returns and volatility. For example, an investor who's very risk-averse might allocate more of their monies to defensive assets like bonds and cash. Typically, you'd rebalance a strategic asset allocation annually. A tactical asset allocation is set based on the investor taking small short-term views or bets on asset classes and investing accordingly. Now, adopting a strategic asset allocation and making small tactical tilts is often the best approach. This means that you decide the range you'd like to invest in any one asset class, which then provides you with some flexibility to make tactical tilts depending on your views at the time. Now, it's important to note at this point that achieving a perfectly balanced asset allocation each year throughout your investment journey is impossible if you invest in property. At the beginning, you'll be very heavily invested in property, but as time passes, you can balance this out. You can't do anything about this, and so long as you're investing in quality assets, it should work out fine. Now, Burton Malkiel, in his best-selling book from 1973, A Random Walk Down Wall Street, popularised the theory that investment returns are entirely random and therefore can't be predicted. Malkiel argued that asset prices typically exhibit signs of a random walk and that no one can consistently outperform market averages. It was demonstrated that a dartboard almost does just as good a job at predicting share returns as the professionals do. I suggest you adopt the belief or agreement that returns are random and no one can predict them. If you invest accordingly, you will likely be better off in the long run. Let's now consider volatility and its impact on your investment returns. The volatility of an investment refers to the likelihood of the investment returns varying from their mean or their average. A highly volatile investment is one where its returns vary widely from one year to the next. A low volatility investment provides stable and consistent investment returns. Volatility can be measured at an asset level and at a portfolio level. Your aim should be to structure your portfolio in such a way that it has low volatility. This typically means that you'll hold a mixture of high volatility assets and low volatility assets. And volatility can have a significant impact on your investment returns. The volatility of an investment is a good proxy for its risk. That is, the higher the volatility, the riskier an investment is. Now, looking at the historical volatility risk of different asset classes over a 36-year period from 1980 to 2016, in comparison to their long-term returns, Investopoly demonstrates that shares have a volatility of somewhere between 20 and 25% a year and a return of between 10 and 13% a year. In comparison, residential property has both an historical return and a volatility of somewhere in the 10% range, while bonds have a historical return and a volatility of somewhere between 8% and 9% per annum. Now, what does this all mean? Well, it means that given Australian shares have an average return of around 11% a year and a volatility of around 21% a year, you can expect that if you invest in Australian shares, your annual investment returns are likely to be in the range of negative 10% to up to positive 32%, which is a very big range. The biggest takeaway from this data, that's well presented in the book in detail, is that returns are random, but volatility is comparatively predictable. Volatility rarely changes. Now, this will help you in your decision of how much to invest in each investment asset class, because you know which asset classes exhibit the highest risk. The next step is now to consider your overall portfolio construction with a focus on combining assets with negative correlations. Now, let me explain. Volatility is only half the story, so let's now look at the other half, which is correlation. Correlation refers to how one asset behaves when a different asset changes in value. So a negative correlation means that when one asset increases in value, the other falls. So a negative correlation is generally what you're looking for to balance your investment portfolio. The role of your asset allocation is to invest in a way that you make money no matter what happens. That way, you don't need to worry about whether the stock market is up or down, as an example. The best way to do this is to invest in assets that are negatively correlated, or in other words, they have no correlation. For example, bonds have a negative correlation with Australian property and shares. Australian shares have a positive correlation with international shares and with US shares to a lesser extent. Virtually no correlation exists between Australian property and international shares, and a very weak positive correlation exists with Australian shares. Now, we can glean a few very key observations from this. bonds and cash have a negative correlation to residential property and shares. Australian residential property has a very weak correlation with most other asset classes, and therefore, to achieve correlation diversification, most investors will benefit from investing in some bonds and cash and fixed interest, some shares, both Australian, international and US, and some direct residential property. A portfolio that includes negatively correlated assets will have some winners and some losers in terms of their investment returns at any given time. But over time, the aim is that the wins more than offset the losses to produce a positive overall return at a overall portfolio level. As a result, the portfolio's overall volatility should be relatively low. So to recap, we've learned that returns are random and that some asset classes are a lot riskier than others due to volatility. We've also covered the benefit of investing in assets that are negatively correlated or have no correlation. So at this point, you're probably thinking, this is great, but what's it all mean? How do I work out how much money to put into each asset class? Well, the answer to these questions is part art and part science, as Stuart demonstrates. You need to consider many things when you determine the best asset allocation for your situation. However, the most important three considerations include your investment horizon, your need to draw income and capital, and your risk appetite or your sleep at night factor. Now let's break these down. Firstly, your investment time horizon. This relates to the amount of time you're able to invest for before you need the monies. You need to consider 2 points of time here. The first one is the number of years until you'd like to retire or stop work. For example, the number of years you're away from turning 60 or 67. The second is the number of years until your death. Now, this is important because if you assume that you retire at 60 and you're going to live until you're 90, then you don't want to invest too defensively or conservatively at the age of 60. Otherwise, you might run out of money. The longer the investment time horizon, the greater the capacity you have to accept higher volatility risk so that you can actually then capture a higher return. Secondly, you need to draw income and capital is important because different asset classes deliver different proportions of capital growth and income. For example, direct property typically provides 20% of its total return in income and 80% in capital growth. International shares provide similar percentages to property and maybe slightly more in income, while Australian shares will typically provide 50% in income and 50% in capital growth. And bonds and fixed interest securities provide most of their return in income. So if you're nearing or in retirement, you might have to tilt your asset allocation towards more income-style investment assets. And thirdly, your risk appetite. How often are you willing to risk a negative return? Once every 20 years or a couple of times of a decade? Do you have the stomach to withstand a loss of 30 to 40% in any one year, as shares can sometimes do? And is your financial position strong enough to be able to afford to take such risks? Answers to questions like these will help determine your capacity and willingness to take on investment risk. If you're risk averse, you should invest most of your assets in safe asset classes. Now, when developing your strategic asset allocation, a few different approaches are possible. One example, among others that are detailed in Invest Optimally, involves calculating 100 minus your age. This equals the percentage of riskier growth assets that you should hold. For example, if you're 80, only 20% of your assets should be invested in growth assets. But if you're 30, on the other hand, 70% of your money should be invested in growth assets. Now, this is an old rule of thumb, and some commentators have suggested that the number should be changed from 100 to 120 to account for lower than expected future bond returns. But it's a good start. As an example only, a balanced approach might be adopted that doesn't favour any one asset class. And you might have an investment portfolio diversified across 20% in Australian shares, 12.5% in US shares, 7.5% in international shares, which gives you about 30% in shares generally, then 5% in cash, 10% in Australian bonds, 10% in international bonds, so in cash you've basically got 25%, and finally 35% in residential property. Now, if you're following this asset allocation now, it's best achieved by investing in property in the early stages of your investment journey and then completing super or complementing it with super and some additional share investments after the property assets have been acquired. The key here is that you need to construct a portfolio of negatively correlated assets so that in any one year you'll have some winners and some losers, and over time the wins should be more than outweighing the losses to result in an overall positive position. Now, a good independent financial planner can assist you in determining what is the right investment asset allocation to suit you at what stage. And I should also emphasise at this point that nothing I'm discussing or anything that Stuart and I discuss during these podcasts is intended to be considered as financial advice. We're only sharing concepts and personal opinions and examples for information purposes, and you should seek out advice from a qualified professional that's based on your personal circumstances, your goals, and your risk appetite. Now, finally, let's have a very quick summary look at golden rule number 7, only invest in investment-grade property. Property investment, if implemented correctly, can help you accumulate substantial wealth. And successful investing in property is actually relatively simple. Too often, however, simple but very costly mistakes are made. And investing in the wrong property is the biggest mistake by far. The wrong property will never produce adequate investment returns. What you need is a good understanding of the 3 attributes that a property must possess to be deemed investment grade. Firstly, it must have a strong land value component, more than 50% for apartments and 60% for houses. Secondly, it must have scarcity, that is, an imbalance of supply and demand, with demand being considerably higher than supply. Land supply, location, and style are the main influences on scarcity. Thirdly, the property must have proven ability to generate strong growth and returns. Given that securing the right property is absolutely critical, obtaining advice from reputable and independent professionals is actually paramount here, like a buyer's agent as an example. Planning out your property portfolio allows you to diversify geographically, by tenant type and by price point. It also allows you to take steps to minimise expenses such as land tax. Growing wealth initially with residential property before branching out into commercial property or equities is typically the better option. You must structure your loans so that you maximise your tax benefits, minimise your risk and maximise your borrowable equity. Doing so will help you accumulate a property portfolio quickly and painlessly. We'll discuss much more on this in the next episode. The right property plus the right managing agent equals fewer problems and fewer tenant hassles, and I couldn't agree more on that point. And finally, if you plan on carrying a large level of debt into retirement, you must plan your debt reduction and your exit strategy. Again, good independent accountants, finance brokers, and financial planners working cooperatively is absolutely critical to managing your transition in this retirement phase. Now, my discussion so far is only just a sampling and doesn't even scratch the surface of the details that Stuart covers in Investopoly. So you'll have to grab yourself a copy of the book to get all of the juice on these and all the other critical rules. Now, these 8 rules provide the essential framework for all of your investment decisions. Next week, we'll drill down to discuss the required fuel to power your investment vehicle, because investing is a game of finance, so the concluding episode will drill down into Stuart's latest book, The Rules of the Lending Game. So, after listening to today's episode, if you'd like to enjoy all of the detailed gold that Stuart shares in his latest 2 books, he's very generously offered you a special reduced price. Now, his books normally retail for $29.95 plus about $6.50 postage, which will cost you a total of about $36.45. However, as a Get Invested listener, Stuart has very generously agreed to offer you a massive 30% discount on both of the books, both Investopoly as well as the rules of the lending game, where you can get them for just $25 each, including postage. Now, all you need to do is jump on www.prosolution.com.au/books and enter the code BUSHY to secure this great discount. Alternatively, and as an added bonus, just email me at bushy@knowhowproperty.com.au, that's bushy@knowhowproperty.com.au, and we'll email you the special discount link to Stuart's books, along with a link to my award-winning book, Get Invested, that you can get for free, excluding postage, that normally sells for $17.25. In the meantime, enjoy the first of my great conversation with all-round investment thought leader, Stuart Weymss. Welcome back, Freedom Fighters. Now, if you've been listening to Get Invested for a while, you know that I've always believed that investing in property is a game of finance and an elite team sport. So today we get to dive into that subject. And rarely do you come across a like-minded investment professional who has multidisciplinary expertise across the key areas of accounting, finance, broking and financial planning. These three key areas are absolutely fundamental to successful investing. And today we get the privilege of doing a deep dive on those subjects with Stuart Wemyss. I've been a big fan of Stuart since reading one of his early books, The Property Puzzle, way back in 2009. And today we're going to do a deep dive on one of my favourite topics from his latest book, The Rules of the Lending Game. So welcome, and let's get invested, Stuart.
Great to be with you, Bushy. Thank you very much.
Thanks for being generous of your time to come and join us, mate. Now, you are extremely well known across the investment sector generally. But for those listeners who don't know you, Stuart, can you sort of start by giving us a rundown on who you are, what you do, and why you do what you do?
Yeah, sure. So I'm a licensed financial advisor and credit advisor, mortgage broker, and also I started my career as a chartered accountant. So I'm also a registered tax agent. And what I currently do is develop long-term strategies for clients, holistic strategies that consider all asset classes and all outcomes, asset protection, cash flow, tax planning, and ultimately trying to achieve their financial and lifestyle goals. And then I work with them over a number of years to implement that strategy and naturally adjust it to accommodate the changes in their life and the inevitable changes in markets and opportunities and risks and so forth to navigate it. I guess 2020 has been one of those years that sort of highlights some of those sometimes unpredictable changes that occur. And I've got a team at ProSolution. My business is called ProSolution Private Clients. So I've got a team that obviously helps me do that. A team of accountants and mortgage brokers and planners and insurance advisors and so forth. But I've always had a really strong belief in independent financial advice. And I started my career, as I said, in chartered accounting. And I used to work for a couple of the big four firms in KPMG and Deloitte. And even at that time, I had financial services sort of specializations. A lot of my clients were in financial services, either from audit, advisory, or valuations, depending on what I was doing at different parts of my career.
Yeah.
I recall sort of back in the late 90s that I was thinking that really what people need is someone to be able to go to someone and say, okay, where do I put my money? And really they need sort of almost someone just directing the traffic, if you like, that doesn't have a vested interest in the outcome. So they might say, look, put a little bit here in super, put a little bit here in property, put a little bit here in the share market, put a little bit here in cash to build up a financial buffer. And that's going to be different for everyone at different times, but you just needed that. And in a institutional level, that's called an asset consultant. So big super funds and large corporates and so forth will hire asset consultants, and that's what they do. And that's what I was thinking. We need an asset consultant at a retail level. So it was always my passion that was always my passion and my passionate belief that that's what people wanted. That's what people really needed, more importantly, because people don't even always know what they need. And that's why I do what I do, because I've, from a very early stage in my career, almost 25, 30 years ago, believed that this is going to derive the best outcomes, not only for myself, and I've used the same approach for building wealth myself personally, but most importantly for my clients. And I do what I do because I love what I do, and I'm really passionate about it. I've got a strong, passionate belief in it. And you really wouldn't write a book, let alone 3 or 4 different books, if you didn't have that passion, because they're a laborious, time-consuming, terrible task, I must say.
And I've written 2, and it felt like blood, sweat, and tears. And it wrung everything horrible out of me. But I've got to say, and you're probably on the same page with this, but it actually helped me to crystallise and communicate the message far better than I did prior to writing the book. So while it's a very painstaking process, I find it quite illuminating, and helps to clarify the way you actually say things better. What are your thoughts around that?
Yeah, it's sort of cathartic writing, I think. It does help you sort of get all your thoughts on one page and organise them into a sort of logical, coherent order. And it forces you to articulate what can be complex concepts or problems in as simple manner as possible. And I think that's the key for most people. I think they don't necessarily want to understand the detail, but they want to understand the logic, and they need that explained to them in simple terms. And I think if you can explain something in simple terms, even if it is complex, it demonstrates that you've truly understood it as well. So, look, I think that's true for books, but I know I write a weekly blog, and I kind of like that process. I like the process of getting it all out of my head onto a page, and just doing a dump and organising it in a certain way. So, I don't enjoy necessarily the process of writing the book, and certainly I hate editing, and that's just not my skill set. But at the end of the day, you look at it, and I'm proud of most of the work that I do, or some of those earlier books, as we've discussed. I'm not a big fan of, but anyway.
Well, there's a lot of people that are, so let me give you some comfort and confidence around that, mate. Great snapshot. What I'd love to do in the context of understanding that very holistic approach that you take, and I think what attracted me as a reader to you initially way back when was the fact that you were probably the only person at the time that was adopting a very holistic approach across the board, that recognised that there is not a one-size-fits all, but there are a number of range of options that people can take in relation to investing that needs to match where they're at and what their capability is and what their risk appetite is. But to help us understand how you got to that point, I'd love for you to take us back through your personal journey, and I'd love you to take us back as far as you would like, and as early as you would like, in terms of where you invested your time, your energy and money, and what you learned from it, and how that's led to where you are today.
Yeah, sure. Happy to. And I probably would say that there's kind of 3 phases or three life cycles of that's got me to where I am today. And I think probably the first life cycle was really, I would say before I started Pro Solution. Well, I think I was about 28 when I started Pro Solution 2002. I'm not that good at maths, so somewhere around that mark. So somewhere between 20 and 28 would be kind of that first phase. And I remember completing my chartered accounting studies, which were really challenging. I never really found any of the academic studies, and I don't say this arrogantly, but I never really found them overly challenging. And to be honest, I always did as much as I needed to do to pass. I was never, certainly through school, never that interested in actually in school at all.
Yeah, did I pick up somewhere that your first passion was to become a gardener? Is that right?
Yeah, that's right. And at high school, and I thought I'll take a subject, an elective on bookkeeping or something. Thinking, if I want to start a nursery or something like that, I'll probably need to know that. Thinking relatively logically at that stage, but and then that's how I got into accounting and really started to like enjoy numbers and those sorts of things. So yeah, it's bizarre how things turn out and how the universe throws those things out. But as I was going through my chartered accounting studies, which were obviously pretty challenging from a learning perspective, I was sort of pulling apart property investing, and I couldn't work it out. And I remember vividly, in fact, I would have been early 20s, and I was doing some exercise and just running around the area that I was living in at the time and looking at different houses and thinking, well, if I bought this and I could rent it out for X, but my costs would be Y, and I'd be losing money. I just couldn't put it together. And really, it would have been late 90s. There wasn't a lot of information around. I mean, I'm sure there was a number of books, but there isn't nearly. I mean, you can jump on it, you can Google something within half a day. You're almost an expert. There's so much free available information.
Yeah,
but it wasn't the case back then. And I just couldn't work it out. I thought, why would anyone invest in property if they're going to lose money? And I didn't even think about the other side of the coin being capital growth, obviously. I bought my first house in Moorabbin around about that time. I think I was 23, 24, paid $150,000 for it.
Yeah.
And it was an okay. Well, actually, I was contemplating, but I was comparing buying that place or a place down the road, but it was actually on a main road. And I didn't. And I thought, I'm not sure what attracted me to the other one, but I didn't put two and two together at that stage that a main road wouldn't be a good location. Anyway, I ended up selling that house about 3 or 4 years later for about $310, I think. So double my money in a very short space of time. And so, after that, that's a pretty good first experience from property investing, I guess. And I
almost
sold
by
that.
accident. I mean, that was your first home, obviously. So it was sort of, wow, okay, this is now I get it. Is that the sort of thing you're talking about?
Lived in it and renovated it, although didn't really spend very much money on it. I did all the work myself, and it was a really rundown property. So I really bought for land value. So I think looking back at some of the things that I did back then certainly weren't by design, but accidentally. A lot of them were right. So that was my first experience, but I still didn't really understand property. I really didn't understand how it works and how investing works and so forth. I was just sort of mulling around, and I thought, we'll sell it. I married my first wife around about that time, and I used we put a whole bunch of money in the bank, and we thought now's a great time to start a business. And as I said, I always had a passion at that stage to really start a business and build a business. It wasn't really about mortgage broking at this time, because we started it as mortgage brokers.
Okay.
And around about the same time, I bought a property off the plan, and I've written a lot over the years about why it's incredibly stupid to buy a property off the plan, in that it doesn't typically make a good investment. But obviously, I didn't know that myself at the time, and it wasn't all bad. I ended up selling it a couple of years later after I realised it wasn't going to work, and certainly didn't lose on it. I think I made about $60,000 on it or something like that.
If you don't mind me digging in there, what sort of are we talking? An apartment or a unit? What sort of a property did you purchase at that stage, mate?
Yes, it was an apartment in a boutique. I call it boutique. There might have been 10 in the block. And it was in a pretty good area. It was in Malvern. I think that side of Malvern Road is actually Toorak.
Yep.
And it was it was built and constructed really well. It was kind of before there was a lot of new build apartments in Melbourne. And I think if they did that project or redid that project today, they'd probably build twice the amount of apartments.
Yeah.
So it wasn't all bad. And it really had some good attributes in terms of locality to public transport and shopping strips and those sorts of things. But it was mostly building value, and for those reasons, it was never going to work. And I think it was just luck of buying that right it was in the right position in the block. Kind of at the right time and paying the right price, not to lose money.
Yeah.
But if I looked at its performance, since I've sold it, it would be terrible.
Yeah.
I was right that it didn't make a good investment. And that was probably the last really bad investment that I made. And so I would call that kind of the first phase where I was just sort of tripping through life, making some ad hoc decisions, didn't really truly understand the fundamentals of what I was doing, and really kind of just getting distracted by shiny objects, if you like.
Yeah.
The next phase of my life would be from probably early 30s through to 2002, which would be sort of late-ish 30s. Well, I'm 45, or mid-30s, I should say. And that period of time, I really did lots of things wrong, I think, from a business perspective, from a personal perspective, and from a financial planning perspective. So I really didn't. I tried to scale my business and hire too many people too quickly. I was probably too focused at the time on money and profit and revenue rather than doing work that I'm proud of. I certainly invested through that time and invested well. So I certainly followed my, and mostly in property, mostly in blue chip investment grade property, which was really good. That's probably the thing that I did right. But I didn't have. I don't think I had enough. I certainly wasn't playing the long game, and I certainly didn't really give a lot of thought to, am I living the life that I truly wanted to live?
Yep.
Or was I just working my ass off and not really producing the results that are actually going to get me to where I wanted to go?
Yep.
If I had have sat down and thought about where I wanted to go. And it was a pretty challenging time. We had, with my first wife, we had 2 young boys, so twin babies, and it's anyone that's had kids, let alone twins, knows that it's a pretty challenging time through that period.
No sleep for about 2 years, I'm guessing, Stuart.
Yeah, no sleep, and I was trying to grow a business at the same time, and frankly, I don't really know how it happened. I was doing some, actually, I lied that off the plan investment was not my worst investment. I was doing, right up until the GFC hit, I was doing some share trading. Still probably a really good indication to everything I was doing wrong at the time. Very, very short-term profit motivated.
Yeah.
Anyway, I was doing okay until the GFC hit, and I lost quite a lot of money. When that hit, I was using CFDs, which is kind of a leverage product.
I traded CFDs in the early 2000s to build up my first deposit on a property, and that was an absolute roller coaster ride.
It's a roller coaster, all right. Oh, it's insane. Anyway, that period of my life culminated in a marital separation. Well, I was lucky enough to meet the woman of my dreams, my soulmate. The unfortunate part was that I was married to my first wife at the time. And long story short, I went to a conference in Istanbul, believe it or not,
wow,
in Turkey, and met her. She's from Melbourne. I'm obviously from Melbourne. And so we went halfway across the world to meet each other, and decided right then and there, that's it. I've got to follow my path, and unfortunately had that separation with my first wife, and that was a pretty painful emotionally and financially process.
I was going to say, mate, with everything that was going on in your life at that time, that the business, the investing, there's a lot of stressors I'm hearing there that must have been a particularly challenging time for you, I would have thought.
Yeah, it was a really stressful time, and I didn't know if I was going to be able to keep my business during that time, because just from the asset split and so forth, in regards to the marital separation, I thought, well, I've worked all this time and maybe I'll end up walking away with almost nothing. At the end of the day, I ended up sort of having to sell all my property, all assets. I lost everything except I retained the business and a bit of debt. So really, not necessarily a very tradable asset, and a debt to go with it. So really, from 2002, it's been the last 8 years sort of rebuilding, and it's been a wonderfully enjoyable and successful time over the last 8 years. I'm very comfortable to say.
Just dive. Sorry to interrupt the flow there, but I'd love you to share. Because I mean that would have been very grounding, and I say that because I've been through exactly the same scenario that you just painted out myself in the late 90s, and looking back on it now, and this sounds crazy, but it's probably the best thing that ever happened to me, because I was forced to have a really good look at myself and what did I need to change to make sure I didn't fall into the same traps moving forward. What were your learnings and reflections that you took away from that quite life-changing experience?
Oh, I mean, there's a lot. I agree. It's very, very, very humbling, I think. I'm almost embarrassed to admit it, but I think ego was probably the biggest issue. Ego was making a lot of my decisions, both lifestyle-wise and financially. To kind of lose all your assets and find yourself in your late 30s going and renting a one-bedroom apartment, not being able to see your kids every day, and being unsure about whether you're going to keep your business. There's nothing more probably unsettling. I'm sure there's probably is, but it's a pretty significantly unsettling situation that makes you prioritise a few things and really work out, where am I spending my time and how effectual am I being, and what value am I bringing to other people, and all those sorts of things. So I'm not sure. I think it was definitely the best thing for many, many different reasons that occurred, even though it was painful at the time. Yeah. But that's probably the biggest thing. Pre-separation, I told myself I had a really successful business. I had all these assets and properties. I was doing really, really well. But when I look back at it, I thought, well, it wasn't that great. I was telling myself a story, and it was a great story. I loved the story. I liked to hear it, but it wasn't true. And to eat a bit of humble pie, reduce your spending, focus on, really building wealth, focus on truly adding value to clients, focus on making sure you're doing work that you're proud of every single day. That's the sort of stuff that, that's the sort of stuff and the way of thinking that's really got me to where I am. And I think it's ironic, isn't it? And it's, the analogy isn't really lost on me, but it's ironic that as soon as you stop focusing on the outcome, the money and the profit and so forth, if you don't focus on it, it comes. But when you focus on it, it doesn't come. And I think it's one of those really strange sort of factors of life that occur in business, but also in lots of different facets of our life. If you focus on the right things, then the positive consequences are just natural. But if you just really attach those positive consequences, you'll almost never get there. Yeah,
really sage words of wisdom right there. Thanks, Stuart. Yep, and something that I hope the audience are really picking up on, because it's very easy in our short-termism world, instant everything now, to lose sight of what it's really all about, and to treat it as a journey and focus on doing the right thing and adding value to others as really key to that, mate. So I appreciate you sharing that with us, mate. Just sort of coming back into it and sort of circling back a little bit, going from an accountant into starting your business in the finance broking space, I find interesting as well, because again, it's not an area that I would have seen myself in years ago as an architect becoming a finance broker, but it served a very good purpose given the critical nature of structuring and strategy around finance to building wealth. What was the attraction for you to pretty much start your business based on a finance broking arm?
Yeah, like everything during that period of time when I said I was just getting distracted by shiny objects, I was before starting Pro Solution, I was at Deloitte and I was in corporate finance doing company valuations. So if a company, a listed company, announces a takeover, in most or certain circumstances under corporations law, they have to get what's called an independent expert report, which suggests to the shareholders whether they should accept or reject the takeover. and the basis of that is undertaking a valuation and making sure it's right or wrong. And so part of doing that, I ended up doing a valuation of Mortgage Choice, and it was before it was listed. It was owned by a company called WealthPoint, and St. George owned a little bit of WealthPoint. And so as a consequence of that transaction, I ended up having to value Mortgage Choice. And that's what highlighted, because at that time in Melbourne particularly, mortgage broking wasn't very well known, and it was just mostly in Western Australia. Really, that's where the industry in Australia started. And so that's what highlighted the mortgage broking industry to me. And then some of my colleagues and my own experience of using a mortgage broker, because it seemed like a good idea. You didn't have to shop around; they did all the work for you. Were terrible, at that stage of the industry. Someone was a truck driver last week, and this week they're a mortgage broker, and then within half an hour you knew more than what they did as an accountant, and it was a terrible outcome. And so I thought, here's a great opportunity. I want to start a business. I love financial services. Here's an industry that's up and coming. Why don't I do that?
Yeah. So
it wasn't really about property, and it certainly wasn't about becoming a mortgage broker. It was more about the opportunity to build a financial services business.
Yep.
And that really attracted me to the industry and to really sort of start Pro Solution.
Terrific, excellent, makes perfect sense. And so, and I interrupted the train of thought there, but we're probably sort of coming into the third phase that you mentioned. Let's go back.
Yeah, that's
there.
right. So that third phase. So the last 8 years, I've really been 100% focused on the long game. So really thinking about what am I doing today. And how can I have the greatest impact over a 10, 20 or 30-year time period? And I've been doing that substantially in my business and the type of clients I'm working with, the advice that I'm providing and the books that I write and those sorts of things, but also in my personal life and investment life. And I've got a very clear vision of what I want out of life and where I want to spend my time. And what I want to do with life and so forth. Particularly, it's inspired by, meeting my soulmate, my wife, and designing a life that we really want to live together.
Love that. That's a great segue beautifully into the question I was going to ask around this. Is what does that look like? What does your ideal life look like? What are you doing where? What's that lifestyle cost? And what are you investing in to help either sustain it if you've got there already or create it if you're still working towards it?
It's just about the flexibility to do a combination of work and play at the same time. And really there is a beautiful quote. I won't recite it because I can't remember it, but the end bit is I work and play and I leave it to others to decide which one I'm doing at the time. Which means that that the work that you're doing is really what you're doing. You're doing what you love, and then when you're in sort of recreational time, if you like, you're also doing what you love. And so my goal or approach really, except for say maybe the last couple of years, which we can always talk about, but for other reasons, I haven't been able to execute on it. But my goal is to really sort of work 3 days a week, and then travel a lot, to overseas holidays. My life, and I absolutely love traveling, and to do that until I stop making sense. Really, there's no work, there's no sort of pre-retirement and post-retirement goals. There's nothing like that. It's really just about having balance, and doing what I love and enjoying life, and doing that for as long as I possibly can. And if I'm still sitting here in 30 years, that would be an absolute privilege, and I would love to do it if the universe allows me to do that. And that's really been sort of the approach. So I'm not really running to a line or running to a point where I need to have 200,000 of passive income, or I need to have 10 million of assets, or whatever that number is. That's not that meaningful to me. It's really about having the balance already and in a way, I would say I am retired. In retirement, I'm not really going to want to do anything else that I don't already do today, except for maybe the travel, and COVID's really upset that. But, apart from that, of course.
Yeah, I love it. I'm convinced we must have been Siamese twins from another mother at some stage, Stuart, because what you've just outlined there is exactly the vision that my good wife Sonia and I are living as we speak. And there is no finishing line. We're playing the infinite game, where we just want to keep doing what we're doing for as long as we're physically and mentally capable of doing it. But in that while balance is a word that gets bandied around a lot and probably overused at times, and this concept of work-life balance, I think, has always been bogus, because if you're doing what you love, you're not worried about it. It's because everything you're doing is part of what you enjoy and the contribution that you're making. So
hard to turn it off too. I mean, if you're really passionate about helping people, and particularly in my situation, helping my clients, then it seems disingenuous and stupid to some degree to say, well, it's 5 o'clock now, I'm going to turn my phone off or walk away from my computer. I don't care anymore. I'm going to focus on going out to dinner or going to the gym or whatever it might be. I think if you're being almost authentic about it, you can't. There's no delineation. I care before 5 o'clock and I care after 5 o'clock, which is not to say I need to be looking at emails throughout for overnight and at any time. But the whole thing around balance just doesn't seem to fit into that, really. I don't think.
I love that, and I mean the good news I'm hearing is that your partner in life and everything is on exactly the same journey, and I think that's really key to the sustainability of that. How important is she in that vision and the life that you're currently enjoying, mate?
Yeah, incredibly important, and I think it's really, really easy to lose sight of it, particularly when you're in your own business and if you're passionate about your own business, because it bleeds and it can end up taking over your life if you let it. It's a little bit, I guess, like, you've got to have some tough love with children sometimes. Giving them everything they want isn't always the best way to raise a healthy child.
Yeah.
And it's the same with business. The goal of... I remember reading something that said the goal of your competitor is to reduce your margin to zero, and it was obviously a business sort of analysis. But really, then I've always thought then the goal of children is to dominate your time, and I don't say that in a really bad way, but really that's what children do, I think, to a great extent. And if married couples then don't make sure that they're selfish with their own time for their own relationship, they risk their relationship dying. And then the same thing then applies to small business, I think. Particularly if you're passionate about it, it can, if you let it, control your entire life. So she's tremendously valuable, and I can't thank her enough. She's amazing to make sure that we keep our eyes on the vision. And I'm passionate about it too, so it's not that difficult. But at times, work can get out of control, and we need to have that balance back to some degree.
Love it, mate. You've sort of touched a little bit on what you've been investing into to fuel and fund that lifestyle. Business is obviously part of that. Beyond business, what have you continued to invest in that's growing the nest egg and generating income? Can you expand a bit on perhaps a property journey and whether it's equities or others that you're continuing to invest in, so we understand how that supports what you're now enjoying?
Yeah, absolutely. I eat my own cooking, which means that I invest in everything that I tell my clients to invest in or suggest my clients invest in. And that can range from direct residential property, direct commercial property. I've also got some investments in unlisted commercial property funds, where 20 investors will go and buy a building together, a business that we align very closely with, which means we're completely separate, but in terms of values, in Melbourne has been doing that for about 30 years very successfully.
That'd be Wakeland, I'm guessing, is it?
Sorry?
Is that Wakeland?
At Wakeland for residential, this is called Vantage Property Investment, and they just do commercial, but they're almost the kind of the Wakeland equivalent in the commercial space.
Yeah.
Equities, of course, ETFs and managed funds, passive style investing in exactly the same way that I do for my clients. And then apart from cash, putting cash in offset, that probably draws a ring around it. We've been very focused my wife and I have been very focused in making sure that we're got a strategy to get where we want to get from a lifestyle property perspective. So what we did is, and it probably speaks to playing the long game and a little bit of delayed gratification and sacrifice. But what we did is we had a smaller apartment in East Melbourne. It's not a bad apartment, but it's not. I mean, I don't enjoy it. It's sort of too small. It's sort of getting too small now. I've got two 13-year-old boys that are with me for some of the time. But we bought a property down the coast, I think about 4 years ago, and we sort of split our time between sort of working in the city and spending a few days down the coast, which I'm able to do, obviously, because I'm sharing my kids with my first wife.
Yeah.
And then, but we've been working away. We've been investing in commercial property, and we only just. I'm waiting for a notification this afternoon that we settled on a much larger apartment still in East Melbourne. But it's been a long period of delayed gratification, I can say, where we've been sort of, if you like, stuck in this small apartment. Not necessarily a place where we want to be. It's not a terrible property. I'm not saying that in a way that should solicit any sadness or whatever. But it has been a really long process of making sure we're investing in a way that we're always constantly moving towards hitting our lifestyle goals. And now that we've certainly achieved that now with the settlement of this property, and we can get back to focusing on investing. But over that time, I've still been naturally investing in other assets.
Yeah, brilliant, mate. And I guess that sort of brings us nicely into Pro Solutions and what you're now doing. And what I love about the way you make this happen from a holistic point of view is that very critical integration of accounting, finance broking and financial planning. Because my own experience, we've certainly experienced or seen situations where each of those professionals is very good at their own little patch, but they may be making decisions that suit the taxation piece that may adversely impact on the lending piece, for example, for someone who's looking for an asset. And likewise, someone in the finance broking space who's just focused on properties and loans may not then be thinking about the sort of ownership or entity structures that need to come into play when you're looking at the financial planning, legacy piece and the taxation treatments down the track. So given that you've magically brought those together under one house, under your tutelage, I'd love to sort of just delve into a little bit about what are some of the biggest mistakes that you find initially a lot of clients that come to you are making around their money and investing, Stuart?
Probably the biggest mistake, and I feel like it's probably going to be a theme through this discussion, but the biggest mistake is being too fearful or too greedy. And I think both of those two emotions are very short-sighted, very short-term focused. And so it's people sitting around procrastinating, not actually taking the step, not actually putting their plans into motion, actually investing. It's the start that stops most people, or chasing too high returns, trying to take shortcuts, trying to make some quick profit. And I think the best analogy that I can give you or example of that I can give you. And I think it's just human nature, right? The human nature is to try and find a quicker way, try and find that shortcut. It seems very attractive, and it is, I think, difficult to resist that temptation to do that. I mean, look at just what's happened this year. Obviously, the market had a major correction at the end of March, and I invested quite a bit of money during April and May. Not all my monies, of course, because I was thinking, well, if the market dips further, but I was happy to buy at the dip And if that wasn't the bottom of the market, I didn't really worry so much because the investments that I was making were otherwise sound, good long-term investments.
Yep.
But at the same time, there were some stocks in the share market, and Afterpay's been talked about a lot. It was trading at around about $8, and it touched $100 recently. So it was very tempting for me to go and say, well, why don't I just go and buy some Afterpay, even if it's not a lot of money, even if it's $1,000, why don't I just do that? And I know that it can be really tempting to do that, but I also know that short-term profit never drives long-term value. And so whilst that small profit might be good, it never gets you closer to your longer-term goal, because either you've then got to think about what's the next Afterpay, what's the next opportunity for me to roll the profit into, or I'm left with making a short-term profit. Well, big deal. It's probably not going to change your life. So it's funny, I found it interesting that even what I know and what I practice and what I preach, it was still difficult to resist the temptation to potentially, even if it was $1, put a little bit of money towards a strategy that's not going to get me any closer to my longer-term goals. So really, I think that's the biggest thing. People are looking for the Afterpay situation, the quick profit, and they're not. They don't have the patience to play that longer game. Vanguard puts together a index chart every year that sort of tracks what the index done over a longer period of time, and they did this small calculation that said if you invested $500 a month in beginning in 1990. That today, 30 years later, your investment would be worth $760,000. So your $180,000 of principal, which is the $500 a month for 30 years, that 180 has grown to $760,000. That's a pretty considerable amount.
No brainer.
Based on a $500 regular monthly investing. So it's not about the amount you're investing, it's just about the discipline to do it regularly, and then the discipline to take a long-term approach. And that was just in the Aussie index. If you had a more diversified international index, you would have done even better over that period of time, maybe worth $1 million. And also that was measured at 30 June this year, and the market sort of bounced back a little bit from there, but it's still being impacted by the pandemic. So, it's all upside, I guess, and those small incremental steps towards that longer-term goal, that's what generates significant value.
Yeah, absolutely. This is the conundrum that always challenges and frustrates me, Stuart, and I'd love your thoughts around this, because every one of us knows, we actually do know, that taking a long-term approach is going to pay off, but not many of us actually follow through on it. So what approaches do you take to shift people's attitudes and their relationships and habits around investing to get them to avoid the short term but to invest in their future self?
It's a great question, Bushy. I'm not sure I have an answer to it. My answer is that I don't think you can do it. I'm very clear about the people that I work with. I work with people that are motivated to build wealth. I don't motivate people to build wealth. And I work with people that are motivated to build wealth in the way that I like to build wealth, which is taking that long-term approach, adopting evidence-based strategies, taking a holistic approach. If that's what people want to do and they're motivated to build wealth, we've got a potentially great working relationship together. If you can't tick either of those boxes, then I can't help you. I'm not a counsellor.
Love it.
But what is it? What is it generically about people avoiding taking the long-term view? I think it's painful. I think we tend to avoid making decisions if they're painful, if it puts us in a more painful process. And I guess the decision not to invest, over investing and taking that long-term approach means that you haven't made that decision yet. You haven't been wrong. You are still ready to make a investment if the greatest opportunity turned up tomorrow. So you haven't, by delaying making that decision, you've delayed the pain of having to make that decision and the pain of having to commit to a 100-mile march. Something that might take 20 years to really pay significant dividends. That feels like a massive commitment. I guess it's a little bit like saying you're going to run a marathon one day, But as soon as you start running the marathon, bang, you're in, you're committed. You've got to keep going. You've got to run those 42Ks. That's a painful process to begin. I think for most people, I think you can then turn it on your head and say, well, what's the outcome of not making the decision? I would argue that's far more painful. And I'd also argue that once you're sort of into that journey, you start to see the dividends, you start to see it really roll. You go back to that Vanguard situation. After 30 years, they're totally convinced that this is the right strategy now. That person's going to continue with it. But they were probably convinced, 10 years or even 15 years after the journey began. So it's I guess it comes back to the story we're telling ourselves about whether it's more painful to make the decision rather than less painful.
Yeah, very well said, and I think you summed it up well there. It's a quote that I pulled out of the property puzzle that I use very frequently. It's the start that stops most people. I just think that sums it up beautifully. But I also love the way you've recognised that, well, there'll be people who are in tune with what we're saying will work with you, and if you're not, that's okay too, but let's not waste each other's time.
That's it.
Well, freedom fighters, how good was that? To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. It's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/get-invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die